President Trump's showing no signs of backing away from his claims on Greenland. Let's get perspective from Sadiq Adatia, Chief Investment Officer at BMO Asset Management. Sadiq, thanks very much for joining us. A guest told us yesterday that this kind of thing, this kind of Trump aggression, for example, geopolitical tension, it tends to be disruptive to the markets, but not destructive. What do you think? Obviously, equity investors are concerned here.
Yeah, I think this is something you see constantly. Geopolitical risks or tensions in other parts of the world, they cause markets to be a little bit uneasy, a little bit nervous. You see volatility pick up. And consumers and investors get a little cautious. And that's kind of what we're seeing at the moment. It's just the uncertainty factor that has people on edge. I think as things play out, it's never as bad as it initially starts to seem. And markets start to embrace it, price it in, and we move on. We saw that last year in multiple times. We saw that with the Russia and Ukraine situation as well. So these are the type of things that I think, catch people's attention. But in the grand scheme of things, not really something that I think, you really want to react to very quickly on. Now, if information gets worse down the road, then that's a different story. But for now, I think it's just a situation where you just want to keep that in your mind, but not really adjust your portfolio significantly.
Let's have a look at a 1 year for the S&P 500. I know it almost comes down to a philosophical question here, Sadiq. Is it even possible to time the market on these things? But there might be a case to be made to lighten up on equities until there's some clarity on Greenland, surely?
Well, our view coming into the year was being bullish on equities, including the U.S. And it comes back to fundamentals. And when you look at the fundamentals of the markets, earnings have been relatively good and they're even broadening out, which is great. We're still seeing consumer spending, and sure, they may be pulling back a little bit on that side of things. And we've seen great market returns. I think that's the part that people are getting nervous about, that because we've had so many good years of positive returns, we must have a pullback. And I don't think, that's necessarily true. But when you get things like we're seeing more recently on Greenland and other things, that helps push that cause to unwind risk or take off some equity exposure along the way. I think a better way to do that is just find hedges, things like gold, or buy options to protect on the downside. That way you stay invested, but you're hedging off some of the risk on the downside in case things do get worse.
Possibly buy put options, for example.
That's correct. Yeah. You can buy them out over various periods of time, and your cost is just the cost of the premium. You don't give up the upside, and therefore you're protected at a given level of risk that you want to take. So if you were worried about a 5% drop, more than 5% drop, you can protect from that onwards, and therefore just exposed to the bottom 5. So you can structure it in a way that makes sense to you. I think that's a better approach than just taking full equity off the table and missing any potential upside, because then you're timing the market.
Broadly for 2026, you're saying overweight U.S. equities, but remain underweight Europe, Asia, and Far East. So stick with a relatively bullish call on U.S. stocks?
Yeah, so we just did our 2026 BMO GAM Outlook call. And one of the 5 themes that we had there was definitely to be underweight international markets. And I think the key reason here is we had a great run last year and led by some of the defense spending, dictated by what was going on in the U.S. administration. I think, this recent example of what's going on with Greenland highlights that there's pressure still on Europe. I don't think it's come out of, the situation where their economy is exceptionally strong and all countries there are swinging at a full level. I think we're still at a point where there's cautious, there is some optimism there, but I think you still want to see the economy move in the right direction and get to a point where you feel really comfortable about investing in that market before you go overweight. So we're underweight that market. We like the U.S. a lot more, highlighted by the comments made earlier, that, earnings still remain relatively strong. It's still the strongest economy out there, and consumers are still spending. And so, when you think about between U.S. and international markets, we will tilt towards U.S. instead.
The bonds, presumably, tell me, should every investor have a reasonable weighting in bonds, Sadiq? I know it varies, but should everybody, as a general rule, have at least some bonds?
Yeah, I think, again, it depends on your horizon, it depends on your risk tolerance. But I think to be prudent, to have a good diversified portfolio, you do need to have it. In periods like what we're seeing now, bonds will tend to do better than equities when we're volatile and nervousness across markets. Now, we have seen bonds be a little bit more correlated with equities, which is why we've been favoring more to gold. But it still is a right thing to have in your portfolio, just because of the diversification benefits it normally has.
What would you do with bonds, though? Would you go long-term bonds, which can be more volatile? They tend to do well, though, if inflation expectations are modest.
Yeah, I would say if you think right now, we're probably expecting a U.S. rate cut, maybe two, which means the short end of the curve comes down. Not the long end changes dramatically. So, I think you just want to position carefully along that, knowing that, yes, rates are probably going to come down, but maybe not as much as people might be expecting, unless we get a flare up somewhere along the way. But I think you want to spread your bond portfolio and add a little bit of higher yielding securities there, not necessarily high yield, but investment grade, for instance, to pick up that extra yield in an environment where if rates are going down, yields might go down at some point as well. So you can pick up an extra yield component, and that's a bit of a safety within your bond portfolio.
Sadiq, thank you very much indeed.
Thanks for having me.
Sadiq Adatia, Chief Investment Officer at BMO Asset Management.